Mm.
Good afternoon to our viewers in Switzerland, and good morning to everyone joining us in the Americas. This is our first webinar of the year, which I hope started well for everyone watching us. I'm Tatiana Gaspar, and as always, it is a huge pleasure to welcome you in the name of the Latin American Chamber of Commerce in Switzerland. This Financial Outlook webinar is offered by our patron UBS and will be an assessment of Latin America in the Roaring '20s. And roaring they are. Halfway through the decade, ongoing geopolitical tensions and their consequences on individual company agendas, I'm guessing, are likely to pose a challenge or two to many of you. Also, the new US administration is currently reorganizing its trade alliances, which is one among many factors influencing the US relationship with Latin American countries. What will be the implications for the economic and investment outlook for the region? We will hear about that and much more from our speaker, who is honoring us with his presence on our screens for the fourth consecutive year. He is the Chief Investment Officer, Emerging Markets Americas at UBS Global Wealth Management in New York. Let's give a warm welcome to Alejo Czerwonko. It's great to have you with us again, Alejo.
Thank you, Tatiana.
Before I give you the floor, I have the pleasure of introducing Andreas Mastai, Managing Director and Lead Market Head, Central, Andean, and South LatAm at UBS in Zurich, who has agreed to deliver the introductory remarks today. A warm welcome to you too, Andy. Good to see you again.
Thank you. It's a pleasure to be here, and thanks for the platform that we can present a little bit Latin America, because interesting times. And Alejo will obviously lead you through that discussion.
Just a second, Andy. I went through the list of participants before and recognized many names of our regular attendees, as well as some members of our board, which is a great pleasure. Welcome, everyone. But as quite a few of our viewers are first-timers, I just want to let everybody know that we are recording the webinar for our YouTube channel, LatCam Switzerland. There will be a Q&A after Alejo's presentation. If you have a question, please write it in the Q&A section of your toolbar. You can also do this anonymously. And now, Andy, I'm inviting you to address this audience, immediately followed by Alejo.
Thank you, Tatiana. As you already mentioned, I think 2025 had a very interesting start. It's shaping up to be a defining year, not only for the financial markets, because we saw the volatility, and obviously after 2 years of stellar performance, over 25% in the markets, it's going to be difficult this year to really overcome that. But also, and that's probably the bigger issue, that the geopolitical and economical shift that we see in the US, obviously in the world, and the consequences for Latin America at the end. I will go into that because I just came back from Latin America. I was in Panama, and I was in Colombia and in Chile. And you can imagine, after the newly elected President Trump basically announced the Panama Canal as his, in certain ways, or as American, I was right there in the country, and there was really a lot of anxiety, a lot of statements from the locals that the canal is ours. I haven't seen so many flags flying, basically, of Panamanians in the country. There is a lot of patriotism going on obviously on both sides. We know that President Trump, in certain ways, it's his way to let's say, to negotiate. He's normally threatening, and then he gets what he wants in that sense. But there is a lot of insecurities inside Latin America in certain countries. Now, another example that I experienced was a few days ago, basically, and I wanted to mention that as well. Colombia. President Pedro refused at the beginning. Let's say it wasn't a long refusal in that sense, but he told President Trump he's not going to accept any refugees back. And Trump obviously overnight said, okay, 25% tariffs, the visas are gone for Colombians. And you can imagine the outrest or the unrest in Colombia by itself. I have an office in Colombia, and I had a talk on Sunday with my head there. There was a lot of Colombians that basically pressured then President Pedro to accept, because obviously they want to have the flexibility of the travel inside the countries. But these moves, and this is basically my message at the end, these moves send a clear signal. Trump is serious. And he's serious about his campaign promises, and this will, by chance, lead to volatility. For us as a financial center, Switzerland, it can be actually positive. We need to be prepared, obviously, to help clients, to help contacts in Latin America, to have open arms, basically, for businesses. And we see that in particular in my region already, there is a lot of flows already coming more into Switzerland than anything and than anywhere else in certain ways. Last point I would like to mention and give you an update on is, and obviously you saw probably on Tuesday, the results of UBS. We are right in the middle of the integration. There is a lot of things that already have happened, and I can mention it in the perspective of Latin America. We've already achieved the merger of all the teams. Basically, we have the teams on one floor here in Zurich, but in all other locations, they're merged as well. We're acting as one. And this, the big advantage that we have, obviously, as combined teams, we are really number one in Latin America. In many other regions as well, Europe, in private banking in particular, in Europe, in Middle East, in Latin America, as I mentioned, number one, number four in the US, meaning it gives us a lot of economies of scale to invest inside the institution, but inside the countries as well. And in Latin America, for us, a focus region, and we have a lot of attention on that region in general. Though we already aligned functions of research. Alejo is actually leading that for the emerging markets as a combined bank, and we'll probably touch on that as well. There is a lot of synergies on the platforms, on the products, on the people, basically, and synergies. We actually take advantage as well with clients. To basically broaden the scope of the financial, of our financial institutions, but of the financial centers here in Switzerland as well. That said, there is one or two challenges in front of us, and I think the biggest challenge is definitely the cultural merge that we still experience in certain ways. I mean, only if you enter the doors here at Paradeplatz, you have a blue and a red entry, basically, in that sense, with two things. This needs to go away in certain ways, because we need to be one and represent one as an institution as well in the market. The other is definitely the merge of the accounts in Switzerland. We have merged a lot of platforms, the accounts already together. We have more than 1 million accounts that are going to be merged over the next few months, and the Q1 2026, this actually should be finished at the end. Looking ahead, as I said, we are in a very complex and dynamic world, not only in the financial markets, but also obviously in the economies that we represent. And Alejo, now it's my pleasure to hand on the word to you, basically to share your insights on Latin America. Thank you very much for giving us the platform.
Thank you so much, Andy. Tatiana, really appreciate the invitation. I'm thrilled to be here with you today. It is rewarding to see that we have built a relationship that persists over time despite a changing world. Fourth consecutive year that we have this conversation. The next one has to be in person, hopefully in Zurich. And of course, everybody is invited to New York City from where I'm dialing in today. I see a number of names that are, of course, familiar, but for those of you who don't know me, Alejo Czerwonko, I'm in charge of the team within the Chief Investment Office at UBS that designs the house view on emerging markets and Latin America. I'm based out of New York. I'm originally from Argentina, but I've been in the US for the last 17 years. My main job is, of course, at UBS, but I do complement this with some activities outside that I think hopefully add some value to my main responsibilities. I teach at Columbia University about investing in emerging markets. It's a graduate course on the evolution of capital markets in Latin America, in Eastern Europe, in emerging Asia. And I do keep a number of relationships with think tanks in Washington, D.C., the Wilson Center, the Atlantic Council, and in Geneva, the World Economic Forum. I think these think tanks do a good job at understanding the tectonic shifts that are ongoing from a geopolitical perspective in the world. And so I try to absorb that and incorporate that into UBS and our thinking. Similar to Andy Mastai, actually together with Andy Mastai, we've been in the region a lot over the last 2 months. So hopefully we can get you fresh insights. In just maybe 8 weeks, I've been in Chile with Andy, in Argentina, in Uruguay, and I just landed back from Brazil, headed off to Mexico next week. The goal for today is to share with you our outlook for 2025, starting with some global remarks to set the stage, put Latin America in context, and then we hopefully have time to double click into our dear region, some of the largest economies within the region, before opening it up to Q&A. So that's the flight plan. I will be sharing just a few slides to help better illustrate the points. If you don't mind, Andy, giving me a thumbs up that you can see them. Yep. All right. So let's go. I would say year ahead 2025, the roaring 20s. Tatiana was making reference to this. We spend a lot of time trying to choose a title of our year ahead report that conveys the message that we want to share with you. And the roaring 20s is inspired by history. It's inspired by the reality that history never repeats itself perfectly, but it tends to rhyme. And we find similarities between the 1920s, the roaring 20s, and the 2020s. I think at a fundamental level, it is the recognition that there is a lot of good stuff going on, primarily when it comes to economics, when it comes to financial markets. But at the same time, as Andy and Tatiana very clearly articulated, we are facing a lot of anxiety on the political and geopolitical realm. And so if you recall and read about the 1920s, the world was coming out of a pandemic at a time, the Spanish flu of 1918. The global economy saw some version of a V-shaped recovery, a pretty significant positive performance in terms of growth, technology adoption with cars, with telephones, with the radio being adopted en masse, and markets responding accordingly with good performance from, for instance, equity markets. But at the same time, the 1920s were punctuated by internal tensions in countries such as the United States, with groups such as the Ku Klux Klan gaining in relevance, anti-immigration measures deepening, and quite a bit of tension between countries, with, in a way, the US emerging as a geoeconomic powerhouse and Europe losing some relative relevance back then. Maybe this helps explain why leaders such as Benito Mussolini came to power in places like Italy in 22. And so when I tell you all of this, I trust that you hear the correlation with the 2020s. Let me give you a bit more detail. So starting with the good news, on the economic side of the equation, the world is looking, if you're just analyzing the Excel spreadsheet, right? The world is looking pretty good. Growth is strong, inflation is moderating, corporate profits are growing. What else can you ask for? The US economy is, of course, leading the pack with growth of almost 3% year over year in 2024 and good momentum going into 2025. China is stabilizing its growth dynamics thanks to more aggressive fiscal and monetary policies, which I think will allow the country to achieve its growth targets of close to 4.5% to 5% in 24, and in the year ahead, maybe something closer to 4.5%. Europe, with its challenges, expanding at close to 1% year over year. The emerging markets contributing, India growing over 6%, Brazil growing over 3% in 2024. So the growth picture is solid. The inflation picture is not perfect, but it's a lot better than it was just 2-3 years ago. We are getting closer to the 2% inflation targets in the US, in Europe. We're not there. We might not get there anytime soon, but this is an environment that is a lot more tolerable for businesses than, at some point, 6, 7, 8% inflation that we had to coexist with. If you add to this the artificial intelligence revolution, which continues to press ahead, of course, it's not a linear journey. DeepSeek was a wake-up call and will undoubtedly change some plans. But what we're seeing is AI is disruptive, is productivity enhancing, and is leading to a gigantic CapEx cycle. I'll give you a reminder in terms of just a couple companies, Amazon and Meta, right? Each of these companies, Microsoft as well, so each of these are committed to invest between $60 and $80 billion a year in AI infrastructure in 2025. So you're talking about each of these companies investing roughly $250 million every day of this calendar year. It's just brutal amounts of money, and this is buildings to host servers that have to be run by an engineer, that have to be cleaned by cleaning people. And so this should be, in a way, stimulative for now. Of course, all of this is being marked by high levels of geopolitical and political stress. Those of you who, I've had the pleasure to talk to before have heard about, the transition from a unipolar world to a multipolar world. We're no longer in the US being the absolute geoeconomic powerhouse. We now have a more even environment with many players, and this multipolarity is leading to conflict. So US-China as a source of conflict, Russia-Ukraine as a source of conflict, the Middle East, Israel, Hamas, Iran as a source of conflict, they're not independent from one another. They're all interrelated and have to do with this multipolarity, with powers fighting each other to see if they can redesign the global geopolitical map in their favor. This will continue and might get worse before it eventually gets better. So conflict between countries is something that as investors, we gotta be ready as entrepreneurs, as business leaders, coexist with. It's not really gonna disappear on its own. And of course, from a political perspective, the world is in flux. 2024 was a super year of elections. 80 countries had some sort of election. And of course, the mother of all battles was the US election. Trump got what could be described as a 18 months to 24-month blank check because Republicans have control of the executive, of the legislative, and add to that pre-existing control of the judicial power. And on the right-hand side of this slide, you can see the policy priorities. Lower taxes, deregulation, lower immigration, America first, higher tariffs. And in the first couple of weeks of the Trump administration, I think, as Andy highlighted, all these priorities are being pushed forward with energy, let's call it, right? This is angst-inducing for the rest of the world. I think what is shocking to most analysts and observers is that there's absolutely no distinction, apparently so far, between allies and rivals. Everybody's treated equally. There is maybe a more aggressive than expected disregard for international organization and multilaterals as tools to orchestrate global coordination and coexistence. And so it's very transactional and bilateral in nature. It's a developing story. Let me give you one example. By the way, if you're interested in this, we have a portal, a live portal of content at UBS. If you Google UBS POTUS 47, President of the United States, POTUS 47, you'll find regular updates on all of these topics. I just want to zero in on tariffs because I trust it's of interest for most of you. When it comes to tariffs, we think it is a tool that will continue to be levered aggressively. However, we do not think that tariffs universally will be applied in an aggressive manner, meaning on every country and every product. We think tariffs will be applied selectively. We continue to assign a high probability to China being impacted by quasi-permanent higher tariffs. And we continue to see threats on Mexico, on Canada as that threats rather than an eventual realization of these tariffs. And of course, next up is Europe, right? And we'll have to see how that conversation evolves. From an investment perspective, that's ultimately what UBS does. We try to help our clients achieve their financial goals. We think there's plenty that can be done in this environment. Starting with equities, our message here is we think there's more to go in stocks, meaning we are expecting equity markets to perform in line with earnings growth. And earnings growth should be positive in the US, roughly 8% for 2025. In Europe, roughly 2.5% to 5% in 2025. And in the emerging markets, including Latin America, something likely north of 10% for emerging markets. That's the visibility we think we have, earnings growth. The economic environment is good. Companies are taking advantage of this. And so we think the size of the pie will grow. Visibility on multiples, that is price to earnings multiples, is not as high. The US is trading, as we all know, expensive. S&P 500 trading at 23 times plus price earnings. This is not cheap. We think it can remain expensive. That's what we are penciling in terms of projection. Price earnings ratios in Europe and in the emerging markets, Latin America, are depressed. Now, what is very important in our view is, yes, we like AI. Yes, I think we should be invested in AI. But this is not the time to throw in the towel and forget about investing in Europe and in emerging markets. Valuations differentials are just so sharp that it's more important than ever to keep the discipline and maintain an exposure to those unloved areas of the world from an equities perspective. Moving on to fixed income. We think position for lower rates is not the right way to say it. We think, it's time to collect carry, collect interest rate. That's what fixed income allows you to do today. You can take advantage of US Treasury rates in the 4.5% range, US investment grade bond rates in the 5.5% range. You can build a fixed income portfolio that is fairly conservative, that can yield a healthy amount of income. And so we think that's what investors can take advantage of. Treasurers of different companies can take advantage of. Another message has to do with commodities moving on, which is, look, the world is unpredictable, and we've been positive on commodities such as gold for quite some time. Luckily, this view has played out. As we are recording today, gold is trading north of $2,800 per ounce. We think the momentum can be sustained, and it's a good catch-all diversifier, meaning you can protect yourself against multiple sources of shocks, inflationary shocks, political shocks, geopolitical shocks. The attractiveness of gold remains relatively high. So that is a summary of the global backdrop. Let me go into Latin America in more detail. And look, I think we gotta recognize that the global and domestic backdrops for Latin America are somewhat mixed. It's not a positive all clear. It's not all negative. On the external front, liquidity conditions are a bit more favorable than a year ago. We shouldn't forget that the US Federal Reserve has already cut interest rates by 100 basis points, 1% in the last 4 months. Europe continues to cut rates. This is good for Latin America because companies can borrow and there's capital flowing potentially, or fewer headwinds in that direction. Now, why do I have an orange check here? Because the visibility moving forward is not very high. The Fed is telling everybody, look, we don't know what Trump is doing. And without that, it's really hard for us to continue to cut rates convincingly. So they're kind of like on pause. And therefore, this easing cycle continues around the world, but has become a bit more uneven. On a more positive note, China is stimulating its economy, and we think will continue to stimulate its economy. And of course, given the very significant economic ties between China and Latin America, this is positive. Finally, I would say the new U.S. administration for Latin America, as Andy and Tatiana, with some examples, were illustrating, is not great, right? I mean, think about the situation in Mexico, the situation in Colombia, the situation in Panama. Everybody's wondering, am I next? With the possible exception of Javier Milei. We'll talk more about that in a couple minutes. Domestically, I would say the growth inflation outlook is mixed. You know, some countries will grow a little more, Peru. Some countries will grow a little less, Brazil. Inflation is relatively under control, with some exceptions, Brazil being case in point. And the Achilles heel of Latin America remains fiscal accounts, right? There are fiscal concerns almost universally, with the exception of Argentina. Fiscal concerns in Mexico, in Brazil, in Chile, in Colombia, a little bit so in Peru. And so this will have to be monitored very closely. It is correlated with the prevailing political environment. If there were to be a regime change in places like Chile or Colombia eventually, or Brazil, this could at the margin improve. Allow me to double click on a few heavyweights. We just came back from Brazil. We held a conference that welcomed over a bit under 4,000 investors in Sao Paulo. And the mood is muted. Don't forget, we're coming out of a pretty challenging month of December that saw a sharp depreciation of the currency, a sharp steepening of the yield curve on fiscal concerns. And, you know, with a country that has 80% debt to GDP, that has accumulated 20 percentage points of additional debt to GDP in the last 10 years. Fiscal dynamics are not great. They're worrying, and Lula has decided not to take this as seriously as he probably should have. And so markets are now discounting that fiscal picture is going to look messy for the remaining period of this administration. Therefore, in the conference, the conversation was around the lack of positive triggers for the Brazil story, at least in the next few months. All the eyes are on the 2026 election. And of course, that is a story that might start playing out before 2026. We will start getting some polls, some idea of where this presidential race is heading by the end of this year. In the meantime, I think Brazilian assets are likely to remain cheap. There is, of course, I think, value in, say, Brazilian stocks. Brazilian equities are trading at 7.5 times price earnings. This is fascinatingly a 40% discount to emerging market equities, which in turn is a 40% discount to the S&P 500. So we're talking about a market that is trading at a 40% discount or a 40% discount. And therefore, only if an investor is very patient, engaging in Brazilian stocks would make sense. But patience, I emphasize, is of the essence. Mexico, very tense week for Mexico. You would be hard-pressed to find an economy that is more exposed to Trump than Mexico. The country exports north of $500 billion a year to the US. This is almost 30% of Mexico GDP, almost 80% of its total exports. So Mexico and the US are tied at the hip. And it's very uncomfortable to live with a Damocles sword hanging over your head in the form of 25% tariffs. I have to say, Claudia Sheinbaum is getting positively recognized for her approach to the crisis. I think that is justified, and she deserves the praise. Cool-headed so far, pragmatic so far, but it takes two to tango, right? And we need to see, even though our baseline scenario is that this 25% tariff that is motivated by non-economic factors, immigration, drugs, is unlikely to be implemented. So we do not think that this 25% tariff will be implemented. We do not rule out other types of tariffs motivated by economic grievances, such as the trade deficit, right? And so we might see this story will continue, and clarity is unlikely to emerge for Mexico. Remember, 2026 USMCA renegotiation is scheduled. Might that be pushed forward to 2025? All of this, you know, for anybody in your seats, positions of power in Latin America, you're likely pausing, right? You're unlikely to pull the trigger on a major investment decision in this environment, and that is damaging for the Mexican economy. So it's going to be a challenging year. Mexico does have buffers in the form of still low debt to GDP, a flexible credit line with the IMF, international reserve stocks, among others. So very, very important to monitor closely. Argentina, the sexiest story in the region. Milei is one of the most impactful leaders, setting the, let's call it, rhetoric and agenda of the pendulum swing politically, globally. And let's first start with the facts. He pulled off something that no other emerging market under democracy has been able to in modern economic history, which is to close a fiscal deficit of close to 4.5% of GDP in 1 year and remaining in power. This is a pharaonic achievement and a key source of macroeconomic instability in Argentina. That is, by and large, under control. Of course, a lot more work needs to be done. If you talk to anybody who does business in Argentina, they tell you we need labor reform, we need tax reform, we need social security reform. All of these are complicated, convoluted, entrenched interests stand in the way, and necessary for a sustained economic recovery in Argentina. I think 2025 is going to be a good year for Argentina because we have an IMF deal that will likely be closed maybe sooner than later with fresh money for the country, because we have midterm elections that, with the information we have today, show Milei has good momentum. And if he's able to solidify his political position, maybe 2026 is the year of difficult reforms of the like that I described: labor, tax, Social Security, among others. From an investment perspective, the turnaround has been, I mean, absolutely impressive. Country risk, or the spread that Argentine bonds pay over US Treasuries, has collapsed from over 2,000 basis points to roughly 600 basis points in 1 year. This is a lot. And of course, not something that can be repeated in 2025. Valuations are not what they used to be, but we think that there's a bit more room to run for Argentine assets this year. You always have to be respectful when investing and analyzing Argentina, that the infamous phrase that there's four types of countries: developed markets, emerging markets, Japan, and Argentina, I think still applies. It is a very idiosyncratic place. You cannot change its nature in 2 years, and therefore respect and caution is always welcome. Chile, we're seeing a bit of a stabilization of macroeconomic conditions. Chile's remaining as the highest rated Latin American country is a very likely outcome. There seems to be momentum towards a political regime change. And so, you know, a country that celebrated 5 years of the estallido social in October of 2025, which was the 5-year, let's call it, anniversary of, you know, came out of that very sizable shock with scratches, but at least standing on 2 feet. Colombia is seeing a very challenging political and fiscal environment. Leadership out of the country, I think it's widely documented to be subpar. With popularity trends as they stand, I think political regime change in Colombia is more likely than not. And there is quite a bit of work to be done because the country lost investment grade. And I think needs to find again its fiscal footing. The situation in Peru is a bit more positive. Political noise has come down at the margin, and we're seeing a number of trends that support growth in 2025, including the opening of the Chancay port, infrastructure projects out of Lima, a little bit more constructive of a business environment. So somewhat of a brighter spot in Peru. Panama is in the crosshairs. We think investment grade rating will be maintained, but we got to recognize that the country is skating on thin ice, very, very close to becoming high yield. And finally, Dominican Republic, an economy that is one of the best performings out there in Latin America. The left-hand chart speaks for itself, outperforming regional peers by a wide margin, a trend that we expect to continue. With that, let me pause. We covered a lot of ground. I really appreciate your attention, your interest, your patience. Before I forget, so that this continues as an ongoing conversation and we don't have to wait until the next year ahead to stay in touch, I would love to invite you to connect on LinkedIn. I am present there, and I try to publish content, a lot of it on Latin America. On a monthly basis, I have a newsletter that you can access with this QR code. I've written about Mexico and Argentina, and I've written about India. I've written about fiscal matters. That was my last piece globally. So I'd love to have you join in on the conversation. And then finally, we have a podcast that has been growing over time, and we are still learning how to do this, but it's been a fun journey. It is a podcast in Spanish. We have a Portuguese version as well, available on Apple Podcasts, on Spotify, on Google Podcasts, wherever you listen to your podcast. This is available, and we put out one episode every 2 weeks, roughly. And we hope that they're interesting and digestible. They're short, maybe 15, maybe 20 minutes. It's about the topics that we discussed today, global topics and Latin American topics. With that, Tatiana, Andy, back over to you.
Thank you very much, Alejo. And Andy too. I receive your newsletter, and it is really each time great to get your insights and to learn more about what's going on in the world. Now, we have a few questions waiting. I'm going to take them by order. First one is from Arnaldo Romera. Could you give an overview of the challenges regarding LatAm financing needs, hard currency debt, impacts with current US Treasuries, term, premium, and potential Trump agenda?
Yes, what I love about this group, Tatiana, is that there's never a shortage of questions.
There isn't.
We could be here for another hour if history is any guide, and we'll still be addressing questions. Yes, so financing needs. I would say it's a mixed picture. It's a mixed picture. The good news is many Latin American economies over the last 20 years have matured in terms of their capital market structure and have increasingly borrowed at the sovereign level, I'm talking about, in local currency. So as much as I discussed, Brazil has a serious fiscal challenge, it is a local currency fiscal challenge, right? So their external financing needs are very modest. That's one example of a big country with big fiscal problems, but they're not external, they're domestic. So different in nature, therefore, with different implications. Is Brazil going to default anytime soon? We really don't think so. Is the Brazilian economy going to blow up in a 1980s, 1990s type of sovereign debt crisis, banking crisis? We really don't think so. So it's a different region from what it used to be from that perspective. What are the countries where we are looking at foreign financing needs more closely, because that might have certain implications over the near term? Of course, Argentina remains case in point. Argentina has a lot of external debt, has negative net international reserves at its central bank. And granted, the situation improved dramatically, and we think that Argentinian bonds are going to be honored in 2025. But there's not a lot of wiggle room. We'll see what the IMF provides. This is a big one. This is an important one. The other country where we're seeing, negative trends and just only marginal recognition that this is a serious problem is Colombia. right, with a somewhat higher stock of external debt. These are some of the considerations. If you're asking more broadly, not just about sovereigns, but also corporates, and you're intrigued about the US dollar sovereign curve and its overall direction, look, we think that it is not very likely that we'll go back to 10-year treasury rates at, in the mid 3%, right? It's a different world from a fiscal, from an inflationary perspective, and so we gotta have to coexist with that. Might the short end of the curve of the Fed adjust? Yes, we think further cuts are possible and even likely. Of course, the Fed is waiting on Trump as much as we all are. I hope that helps, but we do have a lot more work in this space, depending on the nature of the question, and we can, if you get in touch, we can follow up with specific content.
There are 6 more questions, and I think that's about as many as we can take until we have to wrap it up here. So the next one is from an anonymous viewer. Could you share your perspective on the situation and risk regarding Trump in Peru? We see that he wants China out of Latin America, but in Peru, power generation and distribution are now controlled by Chinese companies. We have a copper mine, Las Bambas, and a new port in Chancay, funded by Chinese investments, has just been inaugurated. Reaching an agreement to reduce exposure to China would be difficult. Additionally, we're approaching the upcoming presidential election. That's a long one.
It's a great question, and I do not have a perfect answer. I would simply lead with the observation that China and Latin America decoupling from an economic perspective is not possible. It's at this stage. We are coming out of 25 years of engagement and investment. And the case of Peru is one of the most notable, but by no means the only one. I don't think that Peru can credibly commit to that, right? If push comes to shove, maybe on the back of pressure, there's some symbolic pronouncements, but in short, China is a much deeper presence from an economic and infrastructure standpoint than the US is in many places in Latin America. And the phrase by Larry Summers, when China comes, they give you an airport. When the US comes, they give you a lecture, still applies, right? Because as we speak, the US barks at you, but they don't offer a checkbook in return, right? To substitute for whatever China can offer. So in short, I don't think Peru can commit to divest, decouple from China. Might the country come under some pressure? It's possible. Nothing, you cannot rule anything out, right? Everybody says might be a target.
Next question, Gabriela Garcia Ortiz. Alejo, what is your perspective regarding the short and medium-term effects of non-compliance with the fiscal rule in Chile during 2024, taking into account that this year there will be presidential and legislative elections?
As I highlighted, the fiscal irresponsibility, let's call it, is a constant across most of the region, with a blip around the Argentina last 12 months. When it comes to Chile, we've seen, when you look at the macroeconomic impact from el estallido social, 5 years out, we did a piece trying to take stock of, what was the impact. The most serious place where you see this reflected is fiscal dynamics, right? Luckily, Chile entered the estallido social and the pandemic with one of the healthiest balance sheets at the sovereign level anywhere in the whole world. I mean, it was such a clean, beautiful fiscal balance sheet. We've seen a lot of worsening, which brought you to, a bit of a more challenging place. But still, on a comparative basis to a lot of Latin America and even a lot of the developed world, the fiscal picture in Chile is not great, but elsewhere it can be a lot worse. So I think bottom line is there has to be consolidation. There has to be renewed adherence to a fiscal rule. It can be done in the next administration. And in the meantime, you're benefiting from the fact that everybody else is doing so badly.
Next question, anonymous. How do you see the outlook for El Salvador?
I owe you that, Tatiana. We don't cover very actively. There's not as much to do from a financial markets perspective. It is a country that it is a full-time job to follow, and given resource constraints, I don't feel comfortable giving a solid view.
No problem. Then we take a question from Dr. Philip Nell, our honorary ambassador here at LATCAM. Export taxes increased by 30% in 2024. How would you assess the impact on export competitiveness?
Which country?
Doesn't say.
I mean, as a blanket statement, I would, of course, I mean that negatively impacts competitiveness, particularly at a time that maybe some other countries are going in the opposite direction. Argentina, trying slowly. No?
Actually, excuse me, Alejo, Philip just marked Argentina. That's the country he's asking about.
Look, it depends on what experts, primary experts, which are one of the key. The government is trying to just flexibilize and soften that. I think there's a recognition that key growth engines on a forward-looking basis are going to be commodity exports of the soy, wheat, soft type, commodity exports of the oil and gas type on the back of Vaca Muerta, commodity exports on the, let's call it AI revolution, lithium in the Northern Triangle type. And, there have been efforts in the direction of, attracting investment in the space through the RIKI regime for large investments, and optimizing the tax structure, which I will be the first one to recognize that it remains not ideal. But they're aware. They're aware. The first step to addressing a problem is to recognize it, and I think they're taking some steps in that direction.
Just going to take the next question from Philip Nell. Following the strong decline in inflation in 2024, how do you assess the real exchange rate early 2025 and export competitiveness?
Yeah, so we see most currencies in the region today as fair to cheap, meaning if the question is, is the Mexican peso, the Brazilian real, the Chilean peso, the Colombian peso competitive? We think by and large the answer is yes. The one exception A glaring exception to this rule today is Argentina. As usual, its own animal, right? Going against the grain. But it's important because our observation is that the Argentine peso is expensive, to very expensive, in a way that is not sustainable, but maybe not urgent to address. At some point, it will have to be addressed.
And then I'm going to take the last question from David Canal. What are your perspectives and forecast on nearshoring during this Trump tenure? Last time Trump was in office, we experimented a way of foreign investments of this type in LatAm, motivated by his policies.
There's so much debate around this topic as we speak. We are of the view that nearshoring for now is still alive, maybe with an impetus that is more modest than one would have hoped. But if you think about it in very simple terms, if the US wants to decouple from China, it cannot do it alone. It needs Mexico and maybe other parts of Latin America. If the US wants to keep inflation at bay, nearshoring, Mexico, parts of Latin America are parts of the solution. And based on this analysis, we are of the view that eventually the administration will come to terms and that nearshoring will proceed maybe at a more modest pace, but will remain alive. You got to be open and cognizant of a wide range of scenarios, considering what we're witnessing. I mean, I don't think anybody was seriously believing a 25% tariff threat on Mexico. It might still be a threat, you know, but I think we're seeing so much abuse of the word, but I think applicable, unprecedented policy making that, you know, we got to be respectful that, you know, maybe the nearshoring story may change.
Now, it is unfortunately time to wrap it up. I would love to take more questions, but it's past the hour. I want to express.
That was very efficient, Tatiana. Thank you. We got through them.
It was efficient, I dare say, as usual. I want to express deepest thanks to you, Alejo Czerwonko, for assessing once again the big picture, the mixed picture, and perspectives for the world and for Latin America, and giving us valuable insights into what might be investment opportunities. Thank you also, Andreas Mastai, for addressing our audience and sharing your perception of what's happening in Latin America and in the markets. It was wonderful to have you both with us. Dear viewers, thank you all for connecting and sharing your concerns through the Q&A. You will receive a Zoom inquiry tomorrow. In case one of your questions has not been answered, you have the possibility to send it to me and I will share it with our speaker. You will be able to view Alejo's presentation on our website if you click on this event. And in case you missed part of today's session, the recording will be uploaded as usual to our YouTube channel, LatCam Switzerland, very shortly. Once more, thank you for your interest. Stay tuned for our upcoming events and webinars, and I hope to see you again on the next occasion. Till then, be safe and goodbye.
Thank you, Tatiana. Bye-bye.
Ciao.
Bye-bye. Thank you.